is refinancing? So refinancing is the process of replacing your existing mortgage with a new one, typically with different terms. Homeowners usually refinance to secure a lower interest rate, reduce monthly payments, change loan terms such as from 30 years to 15, or switch from an adjustable rate mortgage, otherwise known as an ARM, to a fixed rate mortgage. Now, some people also refinance to tap into their home's equity through a cash out refinance, which allows them to borrow more than they owe and take the difference in cash. Just like with your original mortgage, refinancing involves an application, a credit check, and closing costs. The main goal is to improve your financial position, but it's important to weigh the costs and benefits to make sure it's the right move for you. When should I refinance my mortgage? Refinancing your mortgage can be a smart move when it helps you save money or better align with your financial goals. You should consider refinancing if interest rates have dropped significantly since you first got your loan, allowing you to secure a lower monthly payment. It might also make sense if your credit score has improved, you want to switch from an adjustable rate mortgage to a fixed rate loan, or you need to shorten or extend your loan term. However, timing is important. Refinancing usually makes the most sense if you plan to stay in your home long enough to recoup the costs of the new loan through monthly savings. What are the benefits and drawbacks of refinancing? Refinancing can offer several benefits such as reducing your monthly payment, lowering your interest rate, or changing your loan term to better suit your needs. It also gives you the option to consolidate high interest debt or eliminate mortgage insurance if you've gained enough equity. However, refinancing also has some potential drawbacks. It often involves closing costs and fees, which can range from 2% to 6% of the loan amount. In addition, if you extend your loan term, you may pay more interest over time, even with a lower monthly payment. It's important to run the numbers and compare your current loan with the new one to see if the benefits outweigh the costs. How much does refinancing cost? The cost of refinancing a mortgage typically falls between 2% and 6% of the loan amount. These costs include lender fees, appraisal fees, title insurance, recording fees, and sometimes points you pay up front to reduce your interest rate. Now, some lenders offer no closing cost refinancing options, but these usually involve a higher interest rate or rolling the fees into your new loan. It's important to request a loan estimate from any lender you're considering so you can compare the costs and ensure refinancing is financially worthwhile. Can I refinance to get cash out of my home? Yes, a cash out refinance allows you to replace your current mortgage with a new, larger loan and take the difference in cash. Homeowners often use cash out refinancing to pay for major expenses like home renovations, debt consolidation, or education costs. Now, to qualify, you typically need to have significant equity built up in your home, usually at least 20%, and meet credit and income requirements. Now, while this can be a helpful way to access funds, it increases your mortgage balance and could extend your repayment period. So it is important to carefully consider whether it's the right financial move for you. What credit score do I need to refinance? To qualify for a conventional refinance, most lenders look for a credit score of at least 620. However, higher scores, particularly those above 740, can help you access lower interest rates and more favorable loan terms. If you're using a government-backed loan, such as FHA or VA, you may be able to refinance with a lower score, especially if you already have a loan through those programs. That said, the better your credit, the more refinancing options and cost savings you'll likely have. How much equity do I need to refinance? Now, for most conventional refinances, lenders want to see at least 20% equity in your home value, meaning your loan to value or LTV ratio is 80% or less. This helps you qualify for better rates and avoid private mortgage insurance, PMI. If you have less equity, refinancing is still possible, but you may be required to pay PMI or accept a higher interest rate. Now, certain government programs like FHA or VA refinances may allow for lower equity thresholds or even allow refinancing when you owe close to or more than your home's value under special conditions.